Ladies and gentlemen, good afternoon. Thank you for taking the time to be with us today. My name is Sameer Shah, and I'm a partner in Khaitan and Company's Corporate and Commercial Practice Group. On behalf of the firm, I would like to extend to each one of you a very warm welcome to this webinar, whether you are in our live audience in India or abroad. This is the sixth and penultimate webinar in our M&A Masters series for 2023. And we look forward to your company throughout the last webinar of the series as well. We are very close to the end of this year's program, and we've received excellent feedback from our audiences, clients, and well-wishers, and incredibly overwhelming participation with thousands of registrations across our webinars. We are very grateful for the interest and support which our clients, associates, and others have shown this year. Today, we are looking at critical issues in M&A due diligence. And in short, the format will involve a presentation by our experts, followed by a Q&A session with audience questions. We have already received several audience questions, and if you have questions as the presentation progresses, please submit them using the facility provided in the chat box of the webinar portal. We will, of course, do our best to cover all questions today, but if there is paucity of time, we will respond offline after the webinar over email. Also, after the webinar, we will send a copy of the presentation, summary notes of the key issues discussed, and a link to the recording of this webinar. To introduce the presenters today are my fellow partners at Khaitan and Company, Arindam Ghosh and Abhishek Dadu. Arindam and Abhishek specialize in public market M&A, and between them bring more than 3 decades of deal experience to the table. Every person who registered for this webinar today has separately received an email with full particulars of the credentials of our presenters. Therefore, let me not stand between you and their presentation and repeat or summarize their experience, but suffice to say, they are all M&A experts with excellent credentials and capabilities. So with that, let us begin with the presentation. Over to you, Arindam and Abhishek.
Thank you so much, Sameer. Welcome, everyone. To start with, if you are looking at a due diligence of a listed company, it is a difficult and complex task. But when it comes to an M&A, the first thing which comes to mind, or one of the first things which come to mind, is a due diligence. In this presentation, what we will speak about is specifically talk about listed company acquisitions, since it's a public M&A kind of concept. So listco due diligences are usually limited in scope. This is because listcos usually have strict disclosure norms under various SEBI regulations, and in addition to those, there are certain regulatory barriers which are applicable to a listco, from providing information, more particularly unpublished price-sensitive information, to people who would want to do a due diligence. So then, if one were to look at a due diligence exercise from the perspective of an insider trading regulation, I'm sure you'll understand, and at the end of the due diligence process, you will note that there is always an information asymmetry. Now, that information asymmetry is between the person who's proposing to acquire, basically the one who's done the due diligence, and the one, the public shareholders who wouldn't have benefit of doing the DD. Now, this is because, of course, the acquirer, that is the person who's proposing to acquire, would have access to, or may have already received, some UPSI, which is unpublished price-sensitive information, as a result of the due diligence process. Thankfully, unlike the old regime, the new regulations now permit due diligences more to, so to speak, they actually permit sharing of UPSI, but then it needs to be done in a particular method. There are certain checks and balances in place, whether or not the acquisition is for a control deal or even otherwise. So why I'm drawing your attention to this control part is because there is a slight difference when it comes to disclosures which are made post sharing of the disclosure, post sharing of the information, and therefore it's necessary to just keep this in mind. We'll come to this a little later in the next slide. And during the course of this presentation, what we will do is we'll explore the implications, the key considerations, and some safeguards to deal with several complexities which surround a listco duty. Now let's move on to the next slide, where what exactly is required to be done is described. I'll discuss that. Now, prior to this UPSI being shared, the board members of the listco have to evaluate the requirement for sharing of this UPSI. And it may be in their opinion that this is not in the best interest of the company, because what the regulations require is they have to arrive at an opinion that the sharing of the UPSI is in the best interest of the company. So let's take an example. In certain cases where the board may want to restrict sharing of the information with certain persons and would not want to kind of give it to all who are kind of wanting it. And let's consider a bid scenario. Now, in a bid scenario, to start with, there are quite a few bidders. And over a period of time, as the process moves on, there will be people who will slowly, opt out or will not make it to the next stage. So there, the board will not want to share the price sensitive information or other sensitive data with the first round bidders. Here, what is usually done is something called an onion peel strategy, which means slowly reveal the data. Maybe in the first round, you just give them generic data about the company, something which is available in the public domain all in one place. The next people who move on to the bidders who move on to the next round have a little more data. And finally, UPSI and other price sensitive data is provided to only those people, only those bidders who make it to the final stages. So that's how an onion peel strategy looks like. In the last slide, we briefly touched upon disclosure requirements being slightly different for control deals and for non-control deals. Now let's discuss that a little further. In case of any control deal, what would happen is there would be an MTO, which is a mandatory tender offer, which would get triggered. There may be certain other acquisitions also which would trigger an MTO. And SEBI regulations consider all of these acquisitions which trigger an MTO similarly, whereas ones which do not trigger an MTO are considered differently when it comes to disclosures of data. So far as the ones where MTO is not kind of triggered is concerned, there SEBI has in its regulations stated that the information, the price sensitive information which has been shared, will have to be generally made available to the public 2 trading days prior to the proposed transaction. Whereas in case of an MTO getting triggered, all the necessary information is required to be made available to the public as part of the offer documents, which is the letter of offer, the draft letter of offer to start with, and the letter of offer, and so on and so forth. So why this difference? The rationale behind this is again uh, information parity, but in addition to that, what SEBI wants to ensure is equal treatment is given to all shareholders. And of course, protection of shareholders' interest is always there in mind. And therefore, what SEBI thinks is that if all the necessary information is made available as part of the offer documents, then the shareholders will be able to make an informed divestment decision. So that's where I will take a pause, and I'll request my partner Abhishek Dadu to familiarize you with a little more of the due diligence process.
Thank you, Arindam, and thank you everyone who's joined us today. A key difference in the due diligence for a public M&A deal and a private M&A deal is the various processes and protections that have been put in place by SEBI regulations. Now, before we get into these requirements, it's helpful to understand why a separate regime has been crafted for public M&A deals. To put it very simply, in a private M&A deal, the only persons getting impacted are the deal parties, so the buyer, the seller, the company. Whereas in a public M&A deal, it's not just the parties to the transaction, but also a lot of public shareholders. As you would be aware, in any listed company, you have a minimum public float of at least 25%. And usually you'll see these be in the range of from a few thousands to a few lakh public shareholders. So the general principle that is followed by SEBI, which is considered to be the gatekeeper of the Indian securities market, is to try and protect the public shareholders at all points in time. So various regulations, such as the insider trading regulations, which plays a key role in the due diligence process, the takeover regulations, the listing regulations, they're all formulated with the sole purpose of trying to bring in more transparency and to protect the interests of the public shareholders. Now, keeping that background in mind, let us go into the requirements of sharing UPSI. Now, these requirements first and foremost apply to the listed company, because the listed company is really the gatekeeper or the owner of the UPSI. And the responsibility of sharing this UPSI falls on the board. So the very first step in a public M&A due diligence is for the board of the listed company to pass a resolution in which it agrees to share the UPSI, and it also specifically resolves that sharing of this UPSI is in the best interest of the company. Now, while this might appear to be a small nuance, it's a very important one, because this brings in the fiduciary responsibility of the directors to in fact assess the nature of the entity which is looking to invest, and to take a call that yes, sharing information with this person or this entity would be in the best interest of the company. Now, once a board resolution has been passed enabling the sharing of information, the listed company must sign a non-disclosure or a confidentiality agreement. This effectively acts as a bridge to enable the flow of information between the listed company and the potential investor. And now that a bridge has been created, the final leg is to actually have a database where the nature of information passed, the date on which it has been passed, and to whom is maintained. Now, the last leg, which is the database, is something known as a structured digital database. This is a development which has happened over the last few years under the insider trading regulations. And the purpose for this development is essentially to have a centralized database where SEBI, which is our securities market regulator, is able to access all relevant information in relation to sharing of UPSI. So to give you an example, let's assume Tesla, which though it's not listed in India, but let's assume it is listed in India. And Arindam, I know, likes fancy cars. So let's assume Arindam has an interest in acquiring a substantial stake in Tesla. So Arindam reaches out to Tesla and says that, look, I want to acquire a substantial stake, and for that I need to do due diligence in your company. So what are the steps that Tesla would need to follow? The first step would be to pass a board resolution. The second would be to sign an NDA with Arindam. And the third, once the board resolution and the NDA are in place, is to pass on the UPSI. Now, at every stage when this UPSI is being passed, Tesla would, in its internal database, need to record the nature of UPSI which is being passed. So, to take an example, if Tesla shares its 5-year business plan, with its projections, capex, etc. So it would state that on the 1st of January, Tesla shared the business plan with Mr. Arindam Ghosh, and the nature of the UPSI here, of course, is the business plan. Now, what this does is that if in the future there is any investigation by SEBI, any sort of movement in the stock price which was suspect, and SEBI wants to now go back and check how the UPSI had been moved, who it had moved to, they have a centralized place to look at. Now, in addition to the responsibilities of the listed company, the acquirer also has certain responsibilities and obligations. Samir, we can move to the next slide, please. The acquirer also has certain responsibilities and obligations. One of the key responsibilities of an acquirer is that the acquirer is now deemed to be an insider. Now, being an insider would effectively mean that the acquirer is no longer permitted to trade in these securities while it is in possession of UPSI. And there is a process which Arindam had touched upon, and which we will go into more detail in the next few slides on how to whitewash that information and then proceed to closing. Samir, we can go to the next slide now, please. In a public M&A deal, the role of an NDA is essential. Typically, an NDA is seen as a preliminary and a very basic document. But in listed company deals, it is perhaps one of the most important documents. And the reason for this is it not only protects the UPSI, but it also protects the company. And I'll explain why. The first part of an NDA is, of course, that you need to sign it prior to sharing of any unpublished price sensitive information. And this effectively creates a legal binding obligation between the parties to protect the nature of information, or to protect the unpublished price sensitive information which has been shared. Now, the content of a listed company due diligence related NDA is a little different compared to other NDAs. Now, what are the key differences? There are two approaches that we really take. The first approach is, in a standard NDA, you include a single clause which says that parties will adhere to the various obligations set out under the insider trading regulations. This is what we internally call the lazy approach, because it's a single shot where you can try and cover all legal requirements. Also a lazy approach because if this is law, in any case, you don't really need to put down that provision, but it's sort of a catch-all, net-all provision. What we generally prefer and what we generally advise our clients to do is to go with the second approach, where we call out specific clauses in the NDA, which include specific obligations on what an acquirer can and cannot do. Now, the nature of these obligations that are put on the acquirer include an obligation not to trade in the securities of the listed company. Second is not to communicate UPSI, which has been shared with the investor, other than as permitted under the NDA. And the third is not to utilize the UPSI which has been shared for any purpose other than the M&A activity. Now, what we have to be mindful of here is that the UPSI is shared with various types of people. It could be with a strategic investor, with a financial investor. In a bidding situation, like Arindam mentioned, you could have 8 to 10 potential bidders, and you're sharing your UPSI with everyone. So to have these protections in place to ensure that some are not just coming in for exploratory exercises. They get a sense on your margins in your material contracts, and they use that for their own business. They get a sense on the business, think it's good, use the same information to buy from the market. because they are able to get it cheaper without having to pay a control premium, right? So to convert it into a pure financial investment at a lower price, to pass on this information to other persons who may or may not misuse it. So these protections are important to be embedded and specifically called out in an NDA. If nothing else, the fact that it's written and an investor signs up to it gives additional comfort to the listed company. Now, the last and perhaps the most important is something called the handcuff provision. Now, a handcuff provision effectively says that if a deal fails vis-a-vis a particular investor, then that investor is not permitted to acquire shares of this listed company for a period of, say, 6 months or 12 months. The rationale here being that you are disincentivizing an investor from walking away from a transaction and then trying to do the deal separately. So let me try and give you a very simple and a potentially realistic example. There is a listed company, they're looking to get an investor, a promoter is looking to sell, let's assume a 10% stake. They conduct the full due diligence. The promoter is asking for a slight premium. The stock is trading at 100. The promoter wants 110 because he's selling a full 10% block, and he's given you access to UPSI, which nobody else could have. Now, after you've done the diligence, the investor has done the diligence, the investor figures that there is an institutional shareholder or a public shareholder who is holding a 10% or an 11% stake and is willing to sell at market price, which is 100 rupees. So he's gotten to do his due diligence, and now he can just use that information, having gotten comfortable, to go and buy off the market with all doubts resolved. This is where the handcuff provision comes in, to ensure that if the person is walking away, that's fine. People have the right to walk away from deals, but you can't enter into a separate transaction in the shares of the listed company. Sam, can we move to the next slide, please? Having discussed the prerequisites of sharing UPSI, we can now move to the next segment of how we can go ahead and trade or transact once the UPSI sharing has been completed. Broadly, there are two options or two scenarios that creep up. The first is a majority acquisition. A majority acquisition is where an investor acquires anything which is above 25% or acquires control of a listed company. And this transaction would end up triggering an open offer. That's the first one. The second is a minority investment, anything which is less than 25%, no control rights, which does not trigger a mandatory tender offer. Now, one general underlying principle to keep in mind is that an investor or any person looking to trade in securities of a listed company is not permitted to trade while in possession of UPSI. And this goes back to what Arindam had mentioned at the beginning of his presentation, that there is a concept of information asymmetry. If there is information asymmetry between the public and a potential investor, then it is unfair to the public and therefore should not be permitted. Now, in case of a transaction which is triggering an open offer, there is a general deemed presumption that in the open offer process and the various documents, which is your public announcement, detailed public statement, letter of offer, in all of these documents, all the pertinent information in relation to the company would be made available to the public shareholders to enable them to take an informed decision on whether they want to stay invested or tender their shares in the open offer. So the question of whether all the UPSI which has been shared has in fact been brought out in the public domain tends to go slightly in the gray zone. And since all public shareholders are given an exit opportunity, there is an argument that a larger leeway is provided to trade in securities. The second situation is where there is a minority investment and there is no MTO which is triggered. Now, this is a lot clearer under the regulations. In these situations, the regulations clearly prescribe that any UPSI which has been shared must be made available in the public domain at least 2 days prior to effecting the transaction. Now, the term effecting, unfortunately, has not been defined under the SEBI regulations, and it could mean either signing the transaction or closing the transaction. A more conservative view, of course, is that you see this being done prior to signing of the deal as opposed to closing, but this is something which often in deals remains open to interpretation. Now, it's also interesting to understand how this UPSI is made public. So it's not that investors are required to go out in the public domain on the stock exchange website and call out a piece of information as UPSI to say that, look, we had done a diligence and we are now sharing this information, which is UPSI. The practical approach on this is that the company would bring out something in the nature of an investor presentation. This could be a 50 or 100-page presentation, and in that presentation, you would perhaps have a single page of UPSI, which is being included, so that all the information which was shared with the investor has now also been put out in the public domain, so as to pair out the information asymmetry which had existed at the time of the due diligence exercise. With that, I'll request Arindam to take us through the leakage and other related aspects in the public M&A due diligence.
Thanks, Abhishek. Let's move on to the next slide. Samir, would you move on to the next slide, please? Anyways. So you would have noticed on many occasions during the early stages of a proposed transaction, usually there are rumors about a potential deal which get picked up by the media. Now, considering that the listco would have shared UPSI with the potential suitor after the board of the listco having decided that sharing would be in the best interest of the company, it becomes a very tricky situation to respond to any questions because of the leak-based media reports. More so, if you are to look at the stage of the transaction where no concrete decision has been made and the decision for the transaction is pending and it depends on the ongoing DD, it becomes all the more difficult. In addition to that, to add to all of this, one of the recent LODR amendments, which is supposed to be coming into effect from 1st of October, their top 100 listed companies are mandatorily required to either confirm, deny, or clarify any media article or material event within the 24 hours of that article or media or that event being coming in the public domain. That makes it even more complex because complying with that mandatory requirement, it's going to be very difficult, because it will have to depend on the particulars mentioned in the media, what stage the transaction is in, what is the policy at the target company's level, whether it is being implemented, the policy to deal with such leakages. So, unless the listco already has a well thought out policy to deal with such situations, it may be very difficult to provide a proper confirmation or a denial. So there, of course, as a general approach, if it's a generic event or a generic kind of media article, then a response can be generic. But if a request is raised for a very specific kind of event, then the listco should definitely have some kind of a policy or a document to respond to it, or else it becomes very difficult at that stage. So in addition to this requirement, there are certain other SEBI regulations which would have to be considered in light of a listco DD. request Abhishek to briefly discuss it before we finally wrap it up.
Thank you, Arindam. Samir, we can go to the next slide, please. The one after this, please, Samir. This is another point which really draws out the difference between private M&A due diligence and public M&A due diligence. A lot of the streams, the chapters, the issues that we look at are common between public M&A due diligence and private M&A due diligence. But there are certain key distinctions as well. There is effectively an independent regime that comes into play when it comes to listed companies. And these are fairly important considerations, and we thought it would be helpful to bring out a few of those in our discussion today. The first is various compliances that are applicable to a listed company under the listing regulations. These include things like a timely disclosure of, say, your financials. If a company is doing a preferential issue, then there's a 2-day prior board intimation and various other small compliance requirements. Each of these are mandatorily required under law. If they are not done, there could be potential penalties. And it's always better to have these checked and cleared up beforehand. In an M&A transaction, we are of course aware that they help in bringing about value adjustment, in bringing about a cleanup of the company before an investor invests. The second is on the takeover regulations, and perhaps the most important one, because this is really the regulation which deals with, for example, a capital buildup by a promoter. It's very common for promoters of listed companies to buy and sell their shares on the market over time. And we have, in fact, and Arindam and I have done those deals where we've come across situations where certain promoters have unknowingly acquired shares and triggered an open offer in the process. And this was only discovered a few years down the line when they were exploring an M&A transaction. So it's important to also analyze and assess whether that 5% creeping acquisition has wittingly, unwittingly been triggered at any point in the past, and if it has, then what is the best potential solution which can be resolved upfront. There are also certain disclosure requirements. For example, if you acquire your initial 5% or more than 2% after that, there is a takeover code disclosure that comes into play. And if these are not done, again, there are consequences. Similarly, under the insider trading regulations, there are pre-clearance requirements which apply to designated persons, which includes promoters, and there are various reporting requirements. So this is really just a nutshell of various additional compliances, regulatory requirements that apply to listed companies, and how important it is to get into each of these aspects in the course of public M&A due diligence. With that, we come to an end of this presentation. We hope you found it helpful, and we're happy to take any questions you might have.
Excellent. Thank you very much, Arindam and Abhishek. And there are, in fact, fair number of questions, so we'll give you the chance to catch your breath, maybe grab a sip of water. What I'll do is I'll try and alternate the questions between the two of you based on which portions were covered. Why don't we start with something along the lines of the new listing regulations that you mentioned? And there's a question saying, do the recent changes place listed companies that propose to acquire other businesses at a disadvantage, as they may be forced to deny or confirm a deal if they are pursuing it?
Okay.
Perhaps, Arindam, if you can take that.
Yeah, of course, I will. Well, I would say that is where exactly the policy requirement comes into place. Now, if you have a very strict policy, or rather not a strict policy, you have a very well thought out policy saying which is the time, when is the time when I would actually go ahead and when the listco will go ahead and make a disclosure that so and so is interested, or we are going ahead with the process, then it makes life so much easier. I have known of situations, I've known of companies who've had these policies since quite some time, specifying exactly, pinpointing the period of time when a general information becomes a UPSI. Now, let me explain it a little further. There might be listcos who are looking at, say, 10 different M&As, but all of them need not be UPSI on day one. They'll be at various stages. So, one way of looking at it is if say the head of the department or head of the M&A vertical decides that, look, now this stage is ripe enough to approach the board for some sort of a approval to go ahead, because obviously the company will need some kind of go ahead from the board. Then that is the time the M&A head or the head of department will make it clear that, look, this is the time where it has become UPSI, and I will go ahead and inform the board, and so on and so forth. So anything which is received, any leak which has happened prior to that can be appropriately responded to, saying, obviously there's nothing to be disclosed, and we would obviously go ahead and disclose it at the appropriate time. So you could continue having the same, approach. But again, if you have proper written up policies in place.
Great. Maybe Abhishek, I can turn to you. It seems to be a relatively simpler question, but you mentioned investment into the company by way of preferential allotment or otherwise. So the question is, do the constraints on diligence differ from an investment into the company as opposed to acquiring shares of the company from other shareholders?
Thanks, Amir. So there is no real difference whether the investment is coming directly into the company, that's a primary transaction, or whether it's a pure secondary transaction. The process for sharing of the UPSI, the process for conducting the due diligence would effectively remain the same. The only difference that we see sometimes is that if it is a pure primary or a pure secondary transaction, you would of course have the promoters or the selling shareholders. In most cases, when you have a secondary, it will be the promoter who's selling, as they are the ones who enable the sharing of UPSI. So the one distinction that might come about is that you could have a tripartite non-disclosure agreement as opposed to a bipartite in case of a primary, because there you don't need any existing promoters or shareholders to be a part.
Understood. And maybe if we stick with you for a moment, because there's a follow-up question on NDAs. So one is a scenario where a listed company is the subject matter of due diligence, whether a business or the company's shares or so on. The other is, let's say, where the acquirer itself is a listed company and is looking to diligence, maybe acquiring a business by way of a slump sale, or let's say even acquiring another listed company. What are the additional bells and whistles which you would expect to see in the NDA? Let's say if we don't take your lazy approach and take the more active approach.
Yeah, we always recommend the active approach. Okay, so a key thing to remember here is that UPSI as a concept comes into existence only and only if your target is a listed company. So if the listed company is buying a private company, then there is no question of UPSI vis-a-vis the private company, right? Of course, at the listed company level, the fact that you are doing this M&A could potentially be considered a UPSI. But from your diligence standpoint, since the listed company is going to diligence a private company, these requirements don't come into play and they're not relevant. A listed company, say diligencing another listed company, because the listco is going to acquire another listco, then all the aspects that we discussed today, they all become equally relevant. And in addition to that, we will also have to be mindful of any disclosure requirements at the acquirer listco level. Because like Arindam just explained in his response before, there could potentially be stock exchange queries if there is a market rumor or a leak, and then parties would effectively need to coordinate and talk about whether there is something concrete in place or whether they are still in exploratory stages and therefore not able to make any concrete disclosure at that point in time.
Understood. Okay. Then there's a specific question on the central database. I'll read the query out exactly verbatim. How does the request for information as a part of public M&A that is registered on the central database help preserve confidentiality and speculative trading on the security at any point before a general offer is issued, but speculators may still take a punt or trade in the meantime? Perhaps Arindam, if you would like to take this one.
Yeah, definitely. Now, if you're talking about the SDD, and then that is something which has to be confidentially maintained. It's not as if, the compliance officer who's responsible for maintaining the SDD can make it available to all the employees. So it's not so. And of course, the compliance officer is supposed to be at a higher pedestal, so we can't say that he will engage in speculative trading. But the other things that Samir, you mentioned, that whether or not entering into SDD will result in speculative trading, the timing, etc. All those questions don't arise because SDD is supposed to be confidentially maintained and only opened up to when the stock exchanges come knocking at your door saying, "Show me your SDD." So,
great. Okay, there's one question around diligence at a lower level. So I'll read the question. Assuming we are conducting diligence on the business of a subsidiary, does that present similar issues from a SEBI regulations perspective? Let's say the seller is the subsidiary of a listed company. Abhishek, would you like to take that?
Yeah, I can take that. So the answer in brief is yes. Now here, of course, I'm making some assumptions. One assumption being that this subsidiary is a material subsidiary. The way, and maybe let me try and answer this more at a conceptual level, and then I'll try to go a little granular. From a listco perspective, we should always look at it on a consolidated basis. So where does the listco derive its value from? One is, of course, its own operations. The second is the operations of its subsidiary, the business of its subsidiary, right? Sort of the revenue upstream. The books ultimately get consolidated. So the price at which the shares of the listed company trade is a reflection not just of the listed company as a separate legal entity, but also a sum and substance of the subsidiaries below it. So therefore, when you're doing a deal which entails important information in relation to a subsidiary, the preferred course of action, and again, assuming it is a material subsidiary, is to actually go through the process of getting the requisite approvals in place.
Understood. Okay, there's a question on non-binding term sheets, Arindam. Maybe if I can come back to you. Traditionally, non-binding term sheets have not been disclosed to stock exchanges. With the new regulations or greater emphasis on transparency, should we consider disclosing non-binding term sheets or not?
Samir, I would say all roads lead to the policy. One size can't fit all. Because we'll have to talk about different companies, different sizes, different businesses. Strictly speaking, a non-binding term sheet can be something on the lines of an exploratory stage situation. Now, if you're talking about a company who does this exploratory stage kind of situations day in, day out, then perhaps you don't need to do anything. But if you're talking about a company who's never done this, they're talking about doing this for the first time, they obviously don't have a policy. If SEBI comes and asks them, why have you done this or that, then it's better to exercise discretion as a better part of valor and disclose it. So, as part of the new regime. So, until now, obviously, I would have said you don't need to, but as part of the new regime, if you don't have a policy, if you can't back it up, then it makes sense to disclose it.
Yeah.
Understood.
And maybe I'll just add one point here to what Arindam said, and we were discussing this earlier today as well. Is the disclosure, of course, it's technically not a requirement, but if you were to make this disclosure, and anyone is free to, it comes with the added commercial risk of a potential price run up, right? So if say you're doing a primary deal or even a foreign investor doing a secondary deal, if you make such a disclosure and the market is to take it well, it's entirely possible the market may not take it well, then it helps your price further because it will fall. But if the market sees it as a good movement, then your price goes up. And the period that you have now between having signed your non-binding term sheet to your actual binding document, in that period, you might just commercially, find that the deal is no longer viable because the price is outside your comfort zone.
Yeah, of course. Thanks, Abhishek. That also is one of the factors that should be considered. I would also say, what's the understanding between the parties? Because obviously, if you are doing a non-binding term sheet, you are, I would say, at least 5-6 months away from the deal, which involves a quarter end. If you're talking about 5-6 months, I'm sure it will involve a quarter end, where so much more UPSI will be made public. So there might be investor calls which might happen in between, where some or the other answers will get disclosed. So it's very like I said, one size can't fit all. Therefore, each company needs to consider its own circumstances and write up a very consolidated, very well thought out policy on what should and should not be done.
Understood. Okay, maybe I'll come back to you, Abhishek. And this is on the point that a potential acquirer, once they have access to information, they have a special status under the insider trading regulations. So there's a question saying, is there any way for such a person to not be classified as an insider? Or is that a slam dunk under the regulations?
Right. So under the regulations, once you have access to UPSI, you're a deemed insider. And there's a slight distinction here. An insider is typically an employee of the company, somebody who's transacting with the company regularly, a supplier, an advisor, a dealer. Whereas an investor has come in for a very specific and limited purpose, which is to try and invest in the company. So from perspective of UPSI, there is unfortunately no way to get out of that mold because you have UPSI. And once you have UPSI, you are bound by the restrictions under the insider trading regulations, which is that you should not be trading while in possession of that UPSI. So in short, while there is a technical difference in practice, really it makes almost no difference because you're bound by the same restrictions as other insiders would be.
Understood. And particularly just on this trading point, there's a question. If the corporate finance team has been pursuing some M&A transaction with a listed company, the deal does not go through, and therefore the corporate finance team within themselves closes the transaction. But there's an important but. However, the treasury team undertakes certain trades from a purely treasury perspective without actually having had access to the insider information. Is there, clearly somebody's had a problem. So is there some exemption which they can use? Right? That's what they're asking.
And Arindam, would you like to take that?
Yeah, of course, of course, of course. That's that's where the concept of a Chinese wall comes in. That's where a concept of how well you can demonstrate that the Chinese wall actually existed comes in. And to top it all, that's where your SDD and the recording, that secure digital database, how well you have recorded your UPSI exchange, that comes into, you know, kind of in the spotlight. Because what SEBI says is that there is a presumption that the deal would have been made on the basis of UPSI. But if it is a corporate, then if it is a corporate entity, there is a defense which is available, and this defense says that the parties who had UPSI and the person who actually traded or gave instructions for the trade were two different parties, and there was no exchange of UPSI between the two. If that is a question of fact, it will have to be, SEBI will have to be satisfied after looking at all these STD, your Chinese wall your procedures, how well it has been implemented, and so on. So that's the long and short of.
Perfect.
And
there's a
I
question. Sorry, go ahead.
Sorry, Sam, if I could just add one thing, this is where the code of conduct internally for private equity funds, for large conglomerates comes into play, because like it works for our law firm. For example, I can take Khaitan as an example. The moment we start looking at a listed company transaction, the first thing that happens is that listed company goes on a grey list. So if any employee wants to trade in shares of that company, you need to ask for pre-clearance, and if the firm is dealing with that, straight out rejection that you can't trade in those securities. Similarly, several of our sponsor clients, private equities, conglomerates follow the same process. And the rationale here, like Arindam explained, was to avoid that situation where you have two hands not talking to each other, and one has sort of gone ahead and done something. Of course, you have your Chinese wall defense, etc. But usually you'd want to not get into that explanation and prevent the treasury team from even trading if there is a sort of higher centralized database which knows that that entity or that company is exploring a transaction with a particular listed company.
Perfect. There's a question from the target side asking what additional hygiene precautions should a target company take so that at its end the information doesn't leak. For example, should we do deal specific NDAs with employees who are in the know? Abhishek, if you'd like to take that.
I can take that. So a deal specific a deal specific NDA is not common, and frankly I don't think it's required. Being an employee of the company, there I think comfort can be drawn from the fact that there is the employment agreement would typically have a confidentiality clause. So comfort can be drawn from there. For anyone external, so for example, and I'm just going to use any fund, right? Fund X is looking to invest in a company, a listed company. So you sign an NDA with Fund X. Now, when Fund X shares the same UPSI with its bankers, its lawyers, you would need to make sure that a similar NDA is signed between X and the lawyer or the banker, or at least there is a sort of joinder to the original NDA. So the idea is that every single step or every single person to whom the UPSI has gone to should mandatorily be bound by provisions of the NDA, which should be of the same standard as the original NDA signed between the listed company and the acquirer. So in summary, third parties, separate NDA for each deal, definitely. Internally, it's typically not required.
Understood. Just going back to the SDD, and perhaps Arindam, you can take this. Just reading the question out literally. Does a financial advisor advising a listed target also have to maintain the SDD?
Unfortunately, yes, they have to. And we've seen this, mentioned in the being mentioned in the FAQ that SEBI has come up with. Even now, we've had situations where SEBI is actually asking, intermediaries who are usually dealing with listcos about how they are maintaining their SDD, to give extracts of the SDD to show, to see how well it is being written up. So it's just a function of time that this SDD will have to be, of course, the regulations require you to have it already, but SEBI has been slightly, easy for the first few years. But now we've seen that SEBI actually asks these intermediaries about SDD as part of their investigation or as part of the preliminary questioning that they do before they issue a show cause notice. So, like I said, yes, it is essential that all of these persons maintain an SDD.
Understood. We probably down to the last few questions, but just in terms of time. So I'll pick you, Abhishek. Can a verbal exchange of information be construed as UPSI, even if it may have been the personal view of the leadership/management?
So that's a bit of a tricky one. So any information, and UPSI is defined pretty broadly, right? It's any information which might impact the stock price. So again, I know I go back to this Tesla example, but let's assume that Elon Musk was to come and tell a potential shareholder that I'm going to take the company private. And this is not done on a Twitter forum, it is done on a one-to-one basis. Then yes, the nature of that information is such that it would constitute UPSI. So whether it's verbal, written, that's not what's relevant. What is relevant really is the nature of the information. Is the nature of the information such that it will impact the stock price? If the promoter of a listed company was to say that we are expecting a huge order in the next 3 months, it's confirmed, we've received the confirmation from the government, that one mere line, it's an order worth 500 crores, right, with a company with a top line of 200 crores. So the stock price is going to shoot up. So the key thing here is, what is the information which is being passed on? And if that information is something which impacts stock price, it will be considered as UPSI.
Understood.
And let's look at the flip side. Sorry. Let's look at the flip side. If it is permitted that such personal interactions are not UPSI, then it opens up a whole new line of getaways, saying, look, that was something personal. I didn't mean anything. That's not the that's not how SEBI would want to look at it, anyways.
Right. Okay. The last question seems to be on, Abhishek, your point on the investor presentation and the large 100 decks of slides. So the question here is, clean teams are Sorry, there's something wrong here. Okay, I'll just maybe try and change the language. Clean teams for antitrust analyses sometimes receive the most sensitive pieces of information, such as market share, etc. How would that be tackled through an investor presentation, as an example?
Right. So again, look, with the clean team, typically the way we do this is, of course, in a clean team, you're restricting it to lawyers, right? The purpose is that you don't let that sensitive information, which you rightly said, you don't even let it pass to the other side, which is the acquirer, because it is so sensitive that you don't want it to be shared at a business or a principal level. Now, for some of these aspects, which are very sensitive, you don't need to go into minute detail. We typically stick to, say, a headline item or a very high level disclosure without having sort of minute bifurcation of requirements. So to give you an example, and maybe I'll flip from market share to, say, a financial projection to simplify this. In UPSI, which is being shared, you could have the breakdown of the entire financial projection, right? 50 line items. But when you're bringing, excuse me, but when you're bringing this out in the investor presentation, it's not necessary for you to bring out such great detail. As long as you bring out the essence and the sort of bottom line on what the projections are, that is sufficient, because the idea is that the public is aware that, look, there is a projection of 15% growth year on year for the next 5 years. Or on the other side, there is a very high likelihood of a substantial reduction in revenue because of certain global events that are happening, and certain supply chains will be cut off and become more expensive. Shipping in this arena is getting more expensive. So the real point here is to have information symmetry. As long as you achieve that, you've achieved the objective of making the information public and fairly available.
Great. So with that, the organizers have pinged me separately, saying we've overshot our allotted time. Maybe, Arindam, if I can request you to probably summarize 3 key takeaways from today's webinar that you think the audience should focus on while conducting diligence with a listed company or on a listed company.
Definitely. Let me think. I would say, there is, of course, a separate process when it comes to a public company, public listed company. Due diligence, people have to keep in mind that there is a separate process for it altogether. The key regulations being, of course, the insider trading regulations. That would be number one. Second is sharing of any price-sensitive information, unpublished price-sensitive information, should be done only if the board of the target company is of the opinion that it is in the best interest of the company. It can't be done otherwise. And third, I would say, coming back to my favorite thing about policy, that in light of the strict LODR provisions which are coming into effect, it makes sense to have a very well thought out policy in place well before it is actually required.
Fantastic. I think that's a very crisp summary. And what we'll probably do is, before concluding, maybe request all of our audience members to participate in the poll. There should be a poll which should appear on your screen very shortly. It's a very short poll, and we take this very seriously as a part of our continuous improvement program. Mitesh, can you put up the poll slide, please? Okay, so with that, we come to an end of this webinar. I would like to thank our presenters, Arindam, Abhishek. Thank you very much for sharing
Thank
your
you.
experiences and your expertise with us today. Clearly, there's a lot to this subject and a fairly detailed nuances at each stage. So thank you once again. And to our audience, we hope you found the webinar interesting and we hope you took away some key tips from it. We certainly enjoyed bringing it to you. And in case there are any questions, there's any feedback, if you'd like to generally just catch up, please feel free to reach out to us. Our speakers' contact information is on the slide in front of you. Just for completeness, after this webinar, we will send you a copy of today's presentation materials, summary notes, and a link to its recording. We will also send you a request for your feedback on the webinar. If you could please take the time to send it to us, we'd be very grateful. We won't steal more than a minute of your time, and we welcome all sorts of comments, criticism, compliments, howsoever you choose to put it across. Thank you for your attendance today, and we look forward to being of service again at future webinars.
Thank you.
Thank you.